Closing down a limited company. How do you do it? And more importantly, what are the things you need to watch out for? Check out this video as we go through all of those details. Peter Johnson. So if you're watching, hi Peter. Peter says, I own 10 properties in my own name. I also own a limited company that owns 4, which again is a standard thing that we're seeing more and more, that people see in their own names. I wish to close the company down via members' voluntary liquidation. Interesting. I would sell 2 of the properties, transfer 2 via a ex specie dividend. Well, we'll talk about that in a minute. And then the insolvency practitioner would keep enough cash in the company to pay the corporation tax on the capital gain. My accountant says, though, says this is a small chance it would be targeted by the anti-avoidance rules brought out in 2016, as it still will be a letting property. He said there are rules were not designed to catch me, but they could do so, basically. And interesting enough, what we do an awful lot of learning ourselves. And I remember we're part of the Chartered Institute of Taxation, as well as the Chartered Accountancy as well board, and both do very good events. CIOT more, the Chartered Institute of Taxation, and there's one particular event where they talked about this very thing. I don't know if you recall, Louise, whereby he said that any distribution via capital of the shareholding, where the company either buys your shares off you or liquidates in a certain fashion, to use this phrase, which is the ex specie dividend, will be seen as a distribution, not as a capital distribution. And HMRC have indeed, I'm not sure the year, so this 2016, maybe more information than I even know, but I certainly know that the person that we was watching pretty much said, don't try this at home, kids, you will get caught out.
It's basically targeted anti-avoidance rules, so something called TAR, and it's also referred to as well as anti-phoenixing. So what it is HMRC are saying, if you close down a company and within 2 years do something same or similar, in a either different company or in your personal name, then they will classify the prior closure of the limited company as exactly as Simon said. It is not a capital gain. Instead, it's considered income. Now, what's the real difference? It's cash in your pocket. You're going to get taxed. If it's taxed under capital gains tax, it's likely to be taxed at either 10 or 20%, depending upon whether you can benefit from a really fantastic relief called business asset disposal relief. And that drops it to 10%. Otherwise, it's likely to be 20%. Conversely, if it's classified as income, which this piece of legislation focuses on, kiss goodbye to up to 45% of that money as tax. Now, which one would you prefer to pay, 10% or 45%?
There is a couple of things that was interesting on that point, because I think what Peter was saying was he's looking to close down the company. And if we break this down, if you've got properties that you have sold, which has then got capital gains tax, and then you want to transfer over, to be honest, this dividend specie may be caught out by income tax rules anyway. If you are closing it down and you have got money left in the bank account, then you would close it down. And as Louise said, you would have this, you wouldn't get BADA, because BADA is related to trade companies. Yes. And if yours is property investments, then you're not going to get this business asset disposal relief. Anyone listening in thinking, what the hell are they talking about BADA for? BADA is a replacement to entrepreneurs relief. So if we just mention entrepreneurs relief, because most people will relate to that, but maybe not BADA, albeit BADA does sound a bit more interesting.
It's a more appropriate definition, that's for sure.
Yeah, it is. So I think in terms of the whole closing down of the company, you can certainly do what you talked about, whereby you've got money left over in the company sells the assets and then transfers the money, but it's not a dividend. It's just a distribution of your capital because you've sold your shares back to the company and then the company closes down. But the one thing I would say about all of that is, if your cash left in the company is more than £25,000, then you'll have to go through an insolvency practitioner. And they're not cheap. I think
is what Peter's talking about anyway, isn't he? He's talking about a voluntary liquidation, which will most likely involve a practitioner.
But the thing is, they're not cheap.
No,
so a practitioner of insolvency is a very niche industry. So you could be paying, the last time I got a quote, not for myself, but someone else, was £14,000. And that was for a very basic, similar to Peter's scenario. So do be careful when we're talking about liquidations and you've got lots of money in there, because one of the ways around that, and it's something that we advise our clients, is just to take your dividends out. And then when it's less than £25,000, then close the company. So you might have to keep your company open for a couple of years more, but is it worth it?
Well, and this is the question I think, Peter, you might want to just ask yourself. If you were to trickle feed the money out of the company in the form of perhaps salary and dividends over time, then, literally waste away the money carefully taken with tax efficiency in mind into your personal name, rather than go through a members voluntary liquidation. I wonder whether that might work better for you and might give you more tax savings. We've looked at this now multiple times for clients. It's a very rare beast that actually works out better value for money for them to go through, if you like, a practitioner to help them close down that company. And it's much better to, as I say, my phraseology, trickle feed the money out as carefully as you can with tax efficiency in mind until there's nothing left.
Before we go any further, I want to explain that there are many live events that you can register for free. There are 4 events that's showing: HK to UK to help people move from Hong Kong to the UK, the Property Expert Panel. If you're a property investor, I'm a property developer, this will be very useful for you. Tax Q&A, if you want to ask proactive tax questions in regards to structures and how to mitigate tax in the future. And finally, UK tax return Q&A, as it says, to deal with questions in relation to your tax returns before you submit it to HMRC. Don't forget that these events are live and will be shown on YouTube the day after. So why not register today, start saving tax tomorrow?